Hi, everyone, and welcome back to another show. My name is Tyler, and I'm with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to discuss how to profit from a market crash. Matt, do you want to share your screen and get us started by going over our current positions?
Sure. Thanks, Tyler. I was in New York last week, so we skipped the show. But the show before that, we put on an earnings, Iron Condor, and DuPont. What did we do? We sold this Iron Condor. Looks like we sold it for... He's doing some math here, Tyler. 77. No, so we did a reverse Iron Condor. Sorry. So we bought the 79. It was a while ago. So I'm trying to get my bearings here. So that was about 50 and then 40, about 90 cents. And DuPont actually, let's see, closed pretty much within that. So I think we lost on that one, that long Iron Condor. We did a reverse Iron Condor, huh? Okay.
Mm-hmm. Yeah, reverse Iron Condor.
Yeah, it was a while ago. But DuPont didn't move that much, so we lost on that dog. So we're talking about how to profit from a market crash, aren't we, Tyler?
Yeah, how to use options to trade crashes. What are you thinking in terms of the tools that we're going to show today? Scanners, backtesters, entry and exit triggers for the backtester. What do you think?
Yeah, so I have long experience in the markets and tend to be always hedged. Coming from the on the floor days and being in the markets for so long, that anything could happen. And so I've actually done really well on crashes. So I thought I would share some of my experience. I do think the market is looking a little bit, shall we say, vulnerable. We got past the election, but I think what we're starting to see is that there are some major cracks in the economy that were kind of hidden by the administration, jobs, et cetera. And so there's some chance for, who knows, what would happen between now and inauguration. So I think it pays to have some out of the money protection in your back pocket. And that's what I'd like to talk about this week, Tyler.
Great. Yeah, we've definitely seen you make a lot of trades with that in mind. You like doing calendars with protection. You're a big fan of the long put. So I'm interested to see what you have to say today.
Right. So let's just review the market a little bit. So, 1 year ago, the market was, in the, what is that? That's 23. So D's 23, 40s, let's just say 47s. And now it's, up past the 57. So quite a bit, maybe somewhere around, 30%. So, I think that there is a decent chance we could get back. There's some trend lines there, but that's only, that only gets us down a wee bit. I think it could be, a lot more substantial than that. So let's say 10% could be, I would say has a decent percentage chance. I don't want to call it 15%, let's say. So what would you do in that case to protect your, I have long, almost always long with protection. So, and I have what's called my personal investing is around something called the permanent portfolio. There's been a lot of videos on it. I won't really go into too much here other than it's 25% stocks, 25% bonds, 25% gold, and 25% cash. And what I do on top of that is I do some options around each one of those, except for cash, each one of those 4 segments. So 3 segments. So protecting those from, when the permanent portfolio is done poorly is when one of them has done really poorly. Usually what happens in the permanent portfolio is when one or two are doing poorly, the other two are doing okay. So I like to augment it with puts. And so let's just do that for, what is the technique I would use, let's say, for protecting that stock position?
Yeah, because everyone knows about the long put, right? But the question becomes, where do I put it, right? Like, how many, what's the delta that I want it at? How far out, do I do this weekly? Do I do this monthly? Like, how often do I have to maintain this long put? I'm interested to hear what you have to say on that.
Yeah. So good questions. So the first thing I start with is our option scanner. And so I'm setting up, kind of a 40-day, every quarter is, let's say, 90 days. So there are 4 of those. So they're, 45 days, 8 of these. So I could do these trades around 8 times. We could also look at the other ones, but I tend to gravitate to a quarter, or even, it could be even longer. So this would be actually on the shorter end. But, again, I think now if you think it's more imminent, you kind of sit on the shorter end. So I would sit on the shorter end, set up a put spread around 40 days, spread out the days to expiration. So I'm going to be looking at a long put spread and a long put. Now, I know I've talked about calendars in the past, but I think calendars are better for not crashes, but just, kind of well orchestrated down moves in the stock. Or even if the stock's going up, you don't lose as much. But I want to get a little bit more aggressive here and do a put spread or a long put. So that's the first thing. So the second, what I like to do is you could set this outlook. So I'm going to use SPX, and I could set this output bearish by 5, 10, 20, or I could put in what I want to, negative. You put a negative in whatever. But I'm going to start with 10%. We'll look at 5% as well. So, and what does that do? So what that does is it changes the distribution percentage. So notice here, so I have long puts and long put spreads. I have deltas about 15 and deltas 25 here. Again, I can move this. What I'm going to be doing is moving the delta range around. I'm going to make the delta range a little bit tighter. So 5% on each side. So I'm going to go 0.2 and 0.3. So, and I'm going to move so we want to know which delta ranges, and do we want to use a put spread? So you have to kind of look at it that way, narrow down. There's so many moving parts. You want to narrow it down. So this is how I approach it. So what we do at ORATS is when we have a bearish outlook, we don't just say 10% down, thus we're going to multiply 5912 times 90% and look there. We say we actually adjust the distribution. And I think that's a better way to approach it. It's kind of hard to see here, but for example, let's take this out. Let's just say neutral. All right, so now with neutral, we'll look at now the distribution percentage multiplies the payoff, the ultimate payoff, that's what you're going to get, almost no matter what, this payoff picture here. And, the green, so at this level, what is it, 3.2%? I know it's hard to see. We're working, actually, I could kind of zoom in a little bit. So 3.2%, at that point, our theoretical expiration is $10,000 profit on that. So way down. And so at that point, you've made $10,000. Okay. So, and then it multiplies that times the percentage, and then adds up this entire expected return and gives you this theoretical value of $30, and it's actually in the market stream 35. So we have a negative edge in distribution. However, if you then change this outlook and be, if it's bear, see how the outlook's slightly leaning long, These are actual moves in the stock that we put in the bucket. But now you can see how it then shifts it down. Do you see that, Tyler?
Yeah. So can you explain a little bit more like how that's calculated? So if we say bearish by 5%, why and how does it shift the distribution like that?
So bearish by 5% then will make it so that the distribution will equal the price of the stock minus 5%. So the expected return of the distribution now becomes 5% down. Does that make sense?
Sort of. So you're looking at historical price movement,
Right.
Given the days to expiration of this trade. So you're saying that this could move, or not this could move, this has moved to this price in the days from today to the days to expiration. So how many days to expiration is that? 30 days? So
30 days, yeah.
Historically, in 30 days, the price has moved plus 1% this many times and plus 2% this many times.
It's not percent, but it's broken out by a distribution that we then spread evenly over. I think it's 22 different buckets, so we just spread those out. Yeah. So this is the actual, and this adds up. This expected return, if you multiplied, all the percentages by the percentages by how up they've been, you'll get the stock price approximately. So if you move it down, or if you say, well, 5% down, then you multiply it, and then it comes out to 5% down.
Okay.
So it's just shifting, it's just shifting the distribution. I think that's a really cool way to do it.
I'm curious that, do you see on the far left there, maybe you can zoom in, but there's a taller bar than I would expect.
Now, the reason that happens is because there's no left tail. Like, we don't have that many left tails, and we want to keep it there. So it's just kind of a spangdrel, or whatever, something that is left over, but pretty much still, that's how we like to do it.
Got it. Okay. So then when you select that bearish by 5% outlook, the distribution percent, that D percent value in the option scanner, is going to increase. Yep.
So it increases a lot. So now we're up at where it was negative 11%. Now it's up at 350% edge. So it thinks the theoretical value is worth that now. So now what you could do, go ahead.
Well, I wanted to tie it back into the theoretical value.
Yeah.
Because this D percent, right? So we have the distribution, which we see there. That's great. So we're coming up with a theoretical value, as we've done with the F percent and the S percent. But this time the theoretical value is factoring in the stock move, this bearish by 5%. And that's why it's coming up with a really different theoretical value. And that's why it's showing an edge, right? Because we think it's underpriced, overpriced, right?
Yeah, I mean, it's way. If this down, if the price of the SPX goes down 5%, then it's very undervalued. It's priced at 36, but it should be priced at 167. I mean, so that's
right. If the stock price, if everyone thought it was going to go down 5% in 30 days, then it should be valued at that price.
That's how you think about it. Now, some people would just say, well, 5%, what's the best option at that 5% level? And they'll just pick that strike. And I think that's not a very good way to do it, because you're kind of saying 5%, a range, and better a distribution.
Right.
So then you could see, okay, now, so that's the ORATS way to do it. So now if we're clear on that, then we could start saying, okay, if we think this is the correct distribution, then we could start to compare, then we could start to pick. The hard part is now, which options should we be buying? Should it be a put spread? Should it be a long put? And, we'll see some techniques to, decide, because there's so many now. So what is the best way to decide? That's what we're going to get into now. You with me so far?
Yeah.
All right, cool. All right, so let's do this. Firstly, let's so now what happens is we have a whole list of puts that are coming up on top. We're sorting. I have a risk reward. I could probably lower that a little bit since we're really concerned about the distribution edge as the biggest one. So distribution edge basically sorted by that right now, and a little bit of risk return. So what we could do is we could say, okay, well, that's 500% distribution edge, right? We could maximize that. So we could say, okay, what if the deltas were lower, like 20%? Now it's 534. All right, so that's a little bit better. What if it's 15%, 520? So now we see there's a sweet spot with 10%, 4. So now I'm kind of saying, all right, if this is the distribution that I'm expecting, it's something in this range. So it's something in the 20% range. 20 delta.
That sweet spot's interesting. This is something a lot of traders struggle with, is that where do I set those deltas? If I think stock's gonna plummet, well, then I'm just gonna buy very far out of the money, like the furthest one I can find. But what you're saying is that's really not a good idea. You should be using the distribution percentage to sort of narrow down that sweet spot with this scanner. It's really interesting.
Yeah, it may or may not be a good idea, but this is a way to make it a little bit more systematic.
Yeah.
So now in this case, we know that if this is the distribution that actually happens in the next 30 days, we know that this is the best put to buy. And what we could do the same thing with the put spread. And then we can compare, then we could use some ways to compare a put spread with a put. So that'll be the next thing. So now let's go find the best put spread, if there even is one on this list. There's a put spread. So it's 484. So let's go, we'll go down one. And we'll see if there's anything that makes the list. That's 362. So that's not the way to go. So let's go. And by the way, I put a 10 strike width. So I could actually widen that. Let's go 5 to 15. So we're not, well, I guess I could even widen it more, but let's leave it there for now. I like to look for put spreads because especially when the volatility is high, like it is now, kind of since we've had the market come down. But we'll look at that in a little bit. So that's why I'm kind of limiting our put spreads strikes, because again, I want to buy one and sell one, and because the volatility is a little bit higher. So that's setting. So now we're at 10. So we know 10's not the way to go. So this is +5, -5D, making this spread wider, making the spread tighter, or resetting it to the default. So 15, are we going the right way? We know we are, because now it's 524. So that's pretty good. Actually, you know what we'll do? I'm just going to take this off, the risk reward off. So we're just sorting. Now the put spread's the best. Actually, there's a 609. So let's go up to 20. Now that's worse, and I'm sure 25 is going to be worse. So now that's interesting. So now what do we find? Yeah. So we found the 15. Now it's slightly different since the market's moving a bit. Now we find a $10 wide put spread, 80 cents. So let's clear this out so we can look at some things here. Okay, so this is going to be a problem. So we want to make sure. So this is a problem. So we never want to have a really wide market or a market that's off. I actually want to take a look at that real quick. So this is this is the 12th of December. So that's a weekly. So this is a wide market. So let's take a look at the option chain. So what I'm doing is I want to look and see why the smooth edge is so great on this one. So the cool thing is it opens it up. So we're selling 1620 against now we're selling 16 against 1609, buying 17 against that. So it looks like this isn't as bad. So these are actually pretty good smooth. I bet you this isn't bad, as much smooth edge now. It might even come up on the scanner, but the scanner takes a while. Bottom line, we want to filter out. So I usually go -1 to +1, and it filters out those kind of markets that might have been wide at the moment, and because this picks the mid market. So does that make sense? The smooth edge, Tyler?
Yeah, we've done the smooth edge on many shows. It's a common filter that we set.
All right, so let's see again now. Let's just see if so it's 464. Let's see if it we'll redo our little test here. So now it's 20, and it's still 464. There it is, 491. So now 491, so that we're going the right way. So let's go up to 25, and it still doesn't break the top. So we'll go down one more and call the 20s kind of the sweet spot for the put spreads right now. 491. Again, just proving to ourselves 15 delta is 474, so we'll go up. So now what we're going to do, Tyler, is even though there's a put here as the top one from a distribution percentage, I still have a couple things I like to look at.
Yeah.
So, for example, I like to look at not just probability of profit. So probability of profit is there. So we'll click on this one, and then we'll go down to the put spread too. So this put spread, and then we'll go across to probability of profit on this one, and this is 80%. So it's a higher probability of profit than 69. So that's a benefit for the put spread. And then I like to look at max gain versus max loss. And, I'll do the old school and just bring up, 1295 divided by the max gain, just divided by the max loss, just to humor me. So I could see that it's 6.3 times for the put spread. And on this one, for the straight put, the max gain is in this distribution is 31.7K, 31,700 divided by what it costs for the put is 209, 2,000. Yeah, that's it. So that's 15 to 1. So that's a pretty good payoff there. Now the problem is you have some let's see the theta. Let's see,
Matt,
yeah.
Isn't the max loss and max gain that you just divided by, isn't that the risk reward ratio?
Yes. I guess I could have just looked right at that.
I think you could have just used that.
Yeah. So here's the risk reward ratio. Tyler's right. I'm going to just look at it right there. So now I don't know. What do you think it is? The problem with the long put is $20, but you don't have to buy as much as those to make a good amount of money. The theta is pretty much is pretty close. So just proving that to ourselves, the daily decay is like 1.3 for that, and then for the put spreads, actually much less for the put spread. So you're going to have a lot less daily decay, but you're not, so you have to multiply that up, in order to compare it well. So it's really is, reward to risk. So I don't know. In this case, if there is a crash, the distribution percentage, you could lean on that. So I do think, even though it seems expensive, you get a lot more bang for your buck for the put. And if it's too much, if 22 is too much, you could use XSP. It would be $2.23. It would be 10 times less. for the XSP. So, this is something that I think about for to protect my portfolio, Tyler.
Yeah, I like it. Are there any other strategies that we could scan on here besides the long put and the long put spread?
Yeah, like I said, you could do something like a calendar, and well, let's do this first. Let's trade this because I think this is going to be a good one, or at least we'll paper trade it. So we'll need to give them at least 5 cents, and then we'll force that. Well, let's right at the offer now. And then we'll look at some of my other ones. So I have option scans that I use on this that are calendars. Let me just find it real quick. So long put calendars. So yeah, so I use this longer term put calendars. I'll clear my stocks and just do SPX. So this is a fair comparison. And then, so it's, 400 days versus 90 days. So this is, like I said, this is what I do just to have something on for every quarter to quarter. So, I'll pay something, pretty high for a very long-term trade. And again, so distribution percentage, if you're bearish by like, again, 5%, it's not going to be that great because then you're going to be, because you have a short put that has a lot more kind of curvature to it. But, still what you want this to do is drift down to that lower put. And you have a lot of time for this one. And you have, a fair amount of decay in the front. So your theta isn't too bad. So, that's another one I look at, just to have something on for a longer term. But again, if I think a crash is coming, this is not what I want to have on.
Right. Great. Are we gonna? So we got that trade for SPX, the long put for 30 days out.
Yeah.
Great.
And,
well, I think that was a good show. I think you explained the distribution percentage really well. We haven't really had a chance to go over that in this much detail, so I think that was good to go over that. And
you could see, Tyler, how you could use that also for up moves and down moves. So if you're, like if you have an axe to grind, as we used to call it, you say, okay, well, I think the stock's going up. How much do you think it's going up over what period? And then you could really narrow down what are the best option strategies to use, based on a lot of these criteria, especially distribution percentage.
Yeah, that's interesting to think about too. Like, it's not just a long call, right?
Right.
There are other strategies you can test and find that sweet spot, depending on the metrics you like risk reward or probability of profit. Of course, distribution percent. So.
Yep.
I definitely learned a lot from that. So thank you, Matt. Thank you, Tradier, for hosting us again. If you guys have any questions, you can email us at support@orats.com. You can also leave a comment on the YouTube video, or if you're a subscriber, you can always ask us and engage with us in our community forums inside the dashboard. So thanks, guys, and we'll see you again next week.
Thanks, Tyler.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.